Hey everybody, how's it going? This is Daniel Kaplan here. Really quick, in this video, I'll be giving you guys an in-depth deep dive on a 147 unit ground up multifamily development. This is a $61 million project. So for any of you who are interested, I will be giving the full A to Z walkthrough of every single nuance of this deal. I'll be diving into really quick our back of napkin underwriting, see the feasibility, if it's even worth us diving into deeper, our assumptions and inputs, our budget and draw schedule, our sources and uses, summary, unit mix, monthly cash flow, pro forma, debt schedule, disposition and exit, and our returns and sensitivities. So I'll be opening up the curtains, showing you this in-depth deep dive of how we are analyzing this full ground-up project. This is a $61 million development deal and looking to probably sell for anywhere from 80 to 100 million. So this is a fun one to look into for any of you who are looking to do ground up development or just looking to understand the nuances of how these deals work, understand the underwriting and the nuanced numbers behind these deals. You'll get a lot of value out of this. I will literally be showing you everything. This is actually the model that is going to be shown to some of the funds and PE shops. I removed a little bit of stuff because I don't want to make this a 3 hour long video diving into everything, but this will give you enough of a deep dive to really understand how these deals work and just overall how this process looks. Right, I'll literally be showing you every single number that is involved in this deal. So yeah, let's dive into this thing. Let me just set my monitor. Give me a second. Okay, we are good to go. So I'm gonna do one shot in this video. So if it's messy, I don't know, I'm sorry. I'll be giving you this authentic video of how these models work and how we analyze these deals. So really quick, before we even go and model this thing out, we firstly put it through our back of napkin analysis. These models take time to build. Because for me, I don't use a templated model. I do not think you should either. Every model that you build should be built from scratch because every single deal operates differently. There are a lot of intricacies, a lot of nuances. So it's important that you make it custom to your deal. So if anyone is selling you on like a template, I probably would not use that. Though a template is nice, right? It's easy to use. I can plug in numbers. But for me, every deal operates differently. I want to dive into the nuanced granularities of this thing, and you can't do that with a template. But before you dive into it, you want to put it through this back of napkin analysis. So let's look through that. This is our initial sniff test. If these numbers pencil, then we go to the in-depth deep dive here. So as we're seeing for this project, this is about a $251 price per square foot on a 242,000 square foot site. This was a quote that we got directly from a builder. We've done deals before in this market, so it's not too unreasonable. For you guys who are trying to look at a deal, maybe go and ask some other builders, ask some other developers in the area, kind of get an understanding of what is a typical price per foot. But so including also, this is blended with our land costs, our surveys, or this is hard and soft costs, our surveys, our permits, literally everything. This is what the actual cost basis should look like, about 61 million. And upon being stabilized, we're seeing for our usable square feet, we'll be renting for about $4 a foot. Given our 136,000 of rentable square feet, that gives us we are expecting about 6.5 million a year in top line rental income, aka gross potential income. And then less our vacancy, plus credit loss, plus loss to lease. Again, we're being pretty conservative with this, but we're expecting our EGI, our effective gross income, of about 6.2 million. And for this, again, the back of napkin model, for OPEX percentage, usually anywhere from like 30 to 40%. For this one, it's Class A luxury deal. We're expecting about 32% OPEX, giving us a projected stabilized NOI of about 4.2 million. And for context, for this deal, it is we'll be building it, renting it out, and then exiting it. And this is actually correct. We're going to be seeing exit cap about 4.5%. Again, these are all numbers that are very easy to go and find, do your market research, look into the submarkets. It is very easy to find what this number actually looks like. So given that, we're expecting this to be valued about 94 million, less our selling costs, our net proceeds should be about 92 million. And hey, if we can net 92, our cost basis is 61, giving us about 31 million in unlevered profit. That passes the initial sniff test. Hey, this deal is worth pursuing further. We know that market caps in the area are about 4.5. We're seeing about 250, let's see, what is the exact amount? What is that? 243 basis point ARB. So that's a very good margin. Where we initially did this, we see these numbers, we now know, hey, this looks like a deal. Let's dive into it further. So again, don't waste your time building a 10-hour model until you do this. Do this first, right? You want to make sure it's actually a deal before you go and dive into. As you see, we're going to get very nuanced with a lot of these data points. So make sure you do your sniff test. So really quick, like I said, this is about a 4-acre site, about 178,000 square feet. So total units is 147. So we're gonna have 122 that are market rate units, and the other 25 are like workforce housing, aka affordable housing units. Again, this is just part of the certain sites restrictions where, hey, 25 of those units are going to have to be affordable housing. We're also going to have some commercial square feet. Again, we just kind of have to. So, including our parking and all that other fun stuff, we're seeing a total gross square footage of about 242,000 square feet. And our actual leasable, like residential square feet for the units is about 136,000. Average unit size of 926. Parking space is 234. Here's our parking ratio. So this is more so in just like the site overview here. And again, for the context, this is how this model works. The blue is the input, the black is the computation. So I can go and mess around with this stuff and the rest of the model will reflect accordingly. We'll be buying this land for about 9.5 million, giving us a price per acre of 2.3. Our price per unit, just on the dirt side of things, is 64K. Price per square foot of land, $53. And so for this, on the due diligence side, we're expecting about 3 months of DD, a 2-month close, giving us a closing timeline of 5 months, aka 150 days. And we're expecting, hey, maybe a closing cost of like 1.3%, let's say. So 123K. Now, let's look at the construction side. And again, this is just our input page. So the hard costs here, and again, this is the GC. It's about 44 million. Hard cost per gross, whatever, GSF, but 183. Hard cost per unit about 303. Soft costs will run us for about 4%, but I think it's going to be more like actually 8%, giving us about 3.5 million there. The developer fee on this will be 4%, getting us about 1.9 million. And then again, these are just some items from the builder. Our permitting period will be 7 months. Our construction period, 14 months. So that's a quick overview on the construction side, but of course, I'll be diving in a little bit deeper over here as we get there. And yeah, now we're going to look at the financing side of things. So for the construction side, we're going to have a loan to cost about 60%. The rate is about 7.5%. We'll have about a 1% origination fee. This is net to the fund. And then we're going to have about 8 months of interest reserves for this deal. And then after the construction, we're going to be refining into a semi-perm loan. This will be once we actually finish the build. Now we're leasing. We'll have like about probably a 2-year, maybe semi-perm. And this will be, hey, we're going to take our existing loan. We're going to go and take 10% as additional proceeds to the fund and then convert it into this new loan at 6%. Probably will be closer to like a 25-year AM actually, and interest only of 3 years. So really quick, just like kind of our equity structure for the fund, the LP pref is about 9%. The GP will be co-investing 10%. The GP promote is 40%. LP is 60%. This is subject to change. It really depends. This could be 20/80, it could be 30/70. Again, all of this is subject to change. This is not a finalized model. And now let's go and look at the actual like leasing side of this asset. So we're seeing average per unit is about 3.1K. Again, this is a luxury Class A development. Our rent per square foot here would be 3.43. And this is current state. By the time the project is finished, we'll be 3 years in. So we're expecting this to be higher with all the other developments near there as well. Annual rental growth about 3%. We'll be expecting to lease about 15 units per month. So it'll be a 10-month lease-up period. Our stabilized occupancy is 94%. Vacancy loss 5%, concessions 2%. Commercial rents, we'll say it's $30 triple net. Other income about $150 a unit for parking, pets, amenities, all that fun stuff. And then from an OPEX, here's our taxes, insurance, management, R&M, payroll, utilities, marketing, reserves, expense growth rate, all that fun stuff for our expenses. And then on the exit, we're expecting a 4.5 cap. Hold period after leasing is 24 months. Disposition will be 2%. And then some other reserves. We'll have about 4 months of OPEX reserves, TCO, property taxes, credit loss, everything. This is important for like the construction side because we still need to go and pay taxes during that duration. Now, the fun stuff, let's go and look at our development costs. So this is the high-level overview. If you want, we can show the very line item per building. This is going to be a 3-building project, but I'm going to skip that part. I'm just going to give you guys a summary of it. So for general requirements, 415K. Site work is 3.85. Concrete, about 11.2 million. Metals 622, carpentry 700, waterproofing 2 million, doors and windows 2.2, finishes 5.3. You got specialties, equipment, furnishing. You guys can read it. I don't want to I don't want to list every single number. But as we can see, the total construction is about 39 million. And then we have the GC conditions, which is like kind of AKA, I think this is more so, what is the conditions? It's kind of like a reserve / contingency. And same with this item here. And then we have insurance and then overhead and fee. That's like the actual GC fee here. We'll probably be getting this removed and getting this a little bit lower. So I'm going to probably, I'll leave it there for now, but that'll probably end up being lower. So total hard cost is 43 million. And then now let's go and kind of look at some other costs. We've got 9.5 for the land, closing cost, hard cost, soft cost. And as we see, I edited it. So now it's actually 8% of hard. Then we got the developer fee, FF&E. So that's giving us about 59 million in total costs after loan origination. Interest reserves were about 60 million. So sources of capital, again, they'll be raising capital for this from LPs. So the construction of it is going to be 36 million, and I don't know what this percentage is from. That's not correct, but that's why you got to double check the stuff. Equity is about 24, so I'm just going to update this. Oops. So as you see, 60-40 split, aka the loan is 60%, our equity 40%, and then LP preferred return is 9%. So this is really quick, just like our draw schedule. Let me move my face out of this way. That's why Loom sucks. Sorry. But as we see, we kind of have our draw schedule where, hey, every month we're drawing from our capital. And it starts off where we're going to pull from the equity first, and then we pull from the debt. So as you see, we're pulling 5%, then 6%. So 3 months is 17%. The next 3 months, another 24%, then 26%, then 24%. And as you can see here, we're going to have this interest accrue from the LPs that are funding the equity portion. So as you see, we lay out, hey, what is our total draw? As we have equity coming in, then we have the debt. We got interest accruing, loan balance, LP interest accruing, all that fun stuff. So we draw 2.1, then 2.6, and cumulative cost is like we're just summing the total of capital that we're drawing. And as you see down here, you have the LP's interest that is accruing based on the amount that we're pulling. And then once we run out of the LP funds by month 7, then we kind of start pulling from our construction draw, which is the heavier interest here, as we see in blue. And then now we can kind of totally see in total how much of the equity portion do we pull, what was the interest as accrued from it, and then the same thing on the debt side of things. And then really quick detailed breakdown. We've got the garage is 54K, building A is 80, building B is 44, building C is 63. Then you get the leasable, acres, units, everything. Oops. And then here's like the deep dive on like a per building itemized basis. So this is more granular regarding that. And then up here was kind of our summary of the total capital allocated on the development side. And then if we scroll down, this is kind of just a breakdown of the total interest that we're accruing based on that, our interest reserve utilization. So this will kind of give us a breakdown of, hey, we paid this much in construction interest, we paid this much on our LP equity, all that fun stuff. So also another note, I think that we'll probably get this to more like 80-90%. So again, this is all subject to change. The beauty is you want to build a model that you can change, that you can edit, and the rest of it is all reflecting. Because all this stuff is subject to change. That is part of the game. So be prepared to edit every single number as you get further and further in your deal, in your due diligence, all that stuff. Now we're going to go over the quick summary. So land acquisition was 9.5, closing cost 123, hard cost was 43 million, operating reserve 463, soft cost, developer fee, FF&E, property taxes, giving us our subtotal of about 60 million. With everything, with origination, interest reserves, getting us to about 62 million on this project. And again, the sources of funds, 60% loan to cost construction loan, 40% LP equity, which I think will be more like 80-20, but hey, who cares? And then now this is our unit mix. We have all of our units. We have, hey, how many of these units? What is the average square footage? What is our rent per month? What is our stabilized annualized rent here? And then we can kind of see quick EGI, some other quick breakdowns on our summaries here. Again, this model is a little bit messy. This is not the fully polished one, but now you can kind of see our key model metrics, our hard cost per unit, development cost, stabilized NOI, yield on cost, exit cap, our spread, the construction loan, the semi-perm, the equity multiple, all this stuff over here. And this is just kind of a quick overview. Again, you'll see this later towards the end of the returns, but really quick deal check, we're able to kind of see what is the anticipated yield. So this is kind of quick sniff test. Hey, we're looking good. Now let's dive into the next part. So again, let me ungroup this. Sorry, usually I would do a shortcut, so don't kill me, guys. But I'm on my MacBook right now, so I don't have it. So project milestones, construction start is by month 8 because the first month is more like the horizontals and the permitting and all that fun stuff. First lease is by month 22, stabilization by month 32. We're going to refi on month 32 as well, exit at month 46. Here's our perm loan amount, semi-perm loan, sorry, our stabilized value, stabilized NOI, boom. So as we see at month 0, we have our initial cost of $9.5 million, 123 in closing costs. So now we can see this is the permitting phase. So we have the monthly costs though of the equity, of the taxes, the insurance, as we see here. And again, as we can see, okay, we've got month 1 through 7 is permitting, and then we kind of start building by month 8. Whereas you see we're incurring all the costs from the draws that we're doing and the interest is accruing. So I don't want to dive too much into nuances of this, but just so that you guys can kind of visualize it, we have the breakdown of like from a development side, from the financing side, our operating performance to see how we're leasing up the units until we get to the occupancy that we're aiming for of 94%. We have our OPEX, our debt service, the capital events from the semi-perm refi to the exit, a breakdown of the total pref return that's accruing for our LPs, and then a quick summary down here, and then like an IRR on cash flows that we can see the GP 68. So on a deal level, it's about 23% IRR, which is great. But again, I don't want to dive too much into the granularities of this, but as you can see, we kind of separate it by each phase of the deal, whether it's the development, to the financing, to the GP-LP splits, to when we're upon stabilization, and we've got our operating expenses, all that fun stuff. And then now we can see here, and really quick, year 1 is like stabilizing, and then year 2 forward is stabilized, as we see over here. So given this, because only we're partially leasing up, but upon being stabilized, we're seeing $5.4 million in revenue, less vacancies, the commercial income, other income, we're at $5.6 million. We've got all of our operating expenses, and let's see, looks like it's too low probably. Sorry, I'm on my Mac, so it's not great. I'm gonna keep using that as my excuse here. But as we can see, our operating expenses, our NOI per unit, expense ratio, yield on cost, OPEX per unit. What's our cash flow after our debt service, which this thing looks pretty amazing. And then we've got, this kind of covers like our stabilized pro forma. So we can see by year 2, we're fully stabilized. We're going to go with all of our units leased. And hopefully by year 3 or year 5, will kind of be the liquidity event here where we're going to be exiting. And then now we've got just our debt schedule where our development costs. So we're just laying out like our different kinds of loan vehicles that we have. Again, the goal is to give this full top-down summary of the deal. So you got development costs, our loan to cost, our construction loan, interest rate, construction period, the loan balance at the conversion, the capitalized interest, additional proceeds that we're going to be netting to us. And then we've got our stabilized, so our stabilized value, implied LTV, interest rate, interest only. And then we got a quick breakdown of just our annual cash flow post being stabilized. So these numbers look great. Now we're going to quickly look at our disposition. So we're seeing quick overview on our timeline. Due diligence and close is 5 months. Permitting is 7 months. Construction 14. It's going to take us 10 months to get stabilized. Hold it for 24 and then exit. So we can see a quick breakdown of what is our timeline here. And I realize I'm flying through this, so I'm glad that this was not going to take us too long. But feel free to pause at any point in this video to like review these numbers and actually like check out what the nuances look like. And then we got our exit, our trailing NOI, which gets us at a 4.5 cap. We got our gross sales price per unit, implied cap rate on cost. So as we're seeing, this deal looks great. So 91 exit, less disposition, 89 sale proceeds. So we're going to have, after paying off the loan, about $45 million in capital to then go and distribute. And we also made about 3.9 when we converted from the construction loan to the semi-perm. And then we'll look at our total equity invested, how much we got the refi, how much cash flow we got from operating, what are our exit proceeds, and then our total distributions, our total profit on the deal. And then we're going to say, hey, the LPs, they contributed 90%, our GPs 10% of the equity, our pref accrued GP fee, so we're also going to make that little fee here. But again, it's a quick back of napkin. We're going to see, hey, the LPs are about to get a 1.8x return over like a 3.5 years or so. And this is very conservative. I think it's going to be higher. And then the GP, as you see, given that we barely contributed any equity, that's why it looks so high. I would kind of ignore this. The most important is like the project level of it. So as we're seeing here, what is the project level? Hopefully I have that in my returns and sensitivities, because that is missing. Now let's look at our returns and sensitivities here. Move my face out of the way. God. Do I have project level? Sorry. Did I not put it in? It's got to be somewhere. I'll be. Okay. Quick tangent, quick side. Let me see. Aside. Here we go. I think that is it. Let me see. Okay, yeah, I do. Okay, about 23%. Okay, sorry. Now let's go and look at our returns and our sensitivities. So we're seeing total development costs 62. We're going to make 89 million on the exit, giving us a 27 million profit, giving us a margin of 43% unlevered, which is fucking phenomenal. Excuse my language. 1.44x equity multiple, which is unimportant. Our yield on costs 6.6. That compared to our market cap, amazing. Our spread 211 basis points. Now we have our levered returns, which get us, okay, I had deal level right in front of my face. I missed it. But at 2x, we're pretty much doubling our money over 3 years on this deal. And here's something important to note. Sometimes people will want to chase a bigger multiple, but it's a totally different ballgame when you're dealing with bigger dollar values. When I go and invest 100 million, it's hard to go and turn that into 300 million over 2 years or 3 years. So maybe on a 100 grand project, yeah, you could go and double your money. But for this is bigger dollar values, bigger value creation. And we also might hold on to this deal in obviously an amazing market. So just some things to kind of like consider as you're looking at the returns. And also just to quickly reiterate, like this is a very service level model. Like, usually we'll get way more nuance, get way more granular, get all the sensitivities, have everything laid out. So this is kind of like our summary view, but we're seeing profit 27 million, equity multiple of 2x, cash on cash for year 1, year 2, not important. Project duration 46 months. Our LP returns, they're going to make a decent amount of profit. They'll make a nice 17 mil on this deal. So not too shabby. We've got our GP returns with our developer fee, our origination fee, our promote split. Hey, we're going to make about 12 million on this deal as a GPs. And then we have some sensitivities on the cap rate, which is probably the biggest driver of our equity multiple and our margin. Because, hey, if we go to a 5 cap instead of a 4 cap, that is a $20 million difference. People underestimate this. Like, this is the most important part. Because you might think, oh, Daniel, it's only 4.5 versus 5%, a 0.5% difference. That's $10 million. When you deal with big value numbers, that is very important. You need to understand the risks and understand your sensitivities. Or what is our doomsday, and are we happy with that? Is it a margin that we are comfortable with? Because there is a chance that, hey, the market is a shit show, and we think it's a 4.5 cap, but it might actually be a 5.5 cap, right? So like you want to be able to underwrite these scenarios where, hey, even if it gets to 5.5 cap, am I going to lose money? Like, okay, my margin is 17% here, but I just want to make sure I don't lose money, right? That's the biggest thing with these deals. Like you need to understand your risks, and are you okay with the risks? That is just underwriting in a nutshell. Is like you need to always see what is our downside. Is that something that I'm comfortable with? But we can see the different sensitivities. If I'm at a 4 cap versus a 4.25 versus a 4.5 versus a 4.75 versus a 5 cap. And then also, what is our equity multiple given certain rent factors? So if I get 90% of the rent versus 95 versus 100, 105, 110. Again, this is saying, hey, I'm projecting, let's say, $1,000 a month in rent. What if it's a $900? Are these exits something I'm happy with? Again, just the things to consider as you're analyzing this. Also looking at our cost overruns and interest rate sensitivity. What if we have to go and refi at a different debt structure than we assumed? So the purpose of this page is, and again, usually you want to get more granular with this, but this is like that initial test to see, hey, if things don't go as I expect, am I okay with that? That is what all this underwriting is, and that is why we have all of these things that we can change and mess around with, is because I need to know, hey, if I deviate from my expected cost on this project or the exit cap, my rental increases, or my OPEX percentage, is that still a yield that I'm fine with? Am I going to be able to go to my LPs and smile when the deal closes if I go and hit that metric? Sorry for the stutter there. But in short, you always want to be analyzing that downside. You want to be saying, hey, I think that market cap might actually be 4.25, but what if it's 5? Right? Like, am I still going to get a yield and a nice margin that I'm comfortable with? That is always the biggest thing with underwriting, is you want to analyze your downside risk, because that is the biggest thing to mitigate. If the market falls in my favor, amazing. I'll be like a pig in shit over here. But I want to see, what if it does not go as planned? What if I don't get the rent that I'm expecting? What if I'm at a 90% rent of my rent and I'm only at a 5 cap when I exit? Is that multiple something I'm okay with? And I might say, yeah, I am fine with that. That net of everything, I still get that yield because it's an $80 million deal. So that is the importance of doing this, of seeing your sensitivities, seeing what my risks are. What if things do not go as planned, and am I okay with that? That is what underwriting is. So I hope you got some value out of this. Again, I could have got way more granular, but I wanted to save you guys the time. Like, I don't need to write temporary fence, your security guard allowance, all that stuff. I don't think it's needed. So hopefully you guys are able to still understand this and understand kind of how these models work, why we do this, and why we kind of break it up as such. But again, I hope you get some value out of it. If you take anything away, it's don't go and buy a template online from somebody. Build your models from scratch. Every deal is different. There are a lot of nuances to this process, so you want to make sure that you're underwriting effectively. So hope this helped. Drop a comment if you want me to shoot over a model or some other examples of deals. Again, I don't give any views in these videos, right? So like, if you drop a comment and have a question, I'll answer it, right? I don't know. Like, this is just fun for me. So let me know. Also, if you have any deals, shoot me a text. I do a lot of deep dives as well on Twitter. So if you want to check out my Twitter, what is my Twitter? Let me see. Daniel Kaplan RE. It's this one right here. So hope you get some value. Hope you enjoyed this.